Time now for the business news with Kate Moody. Kate, good evening.
Hi, Delana.
U.S. regulators are proposing new regulations that would affect the crypto industry.
Yeah, the Securities and Exchange Commission has voted to put forward rules that would, in theory, increase protection for investors. The proposal would expand the scope of existing oversight of financial or investment advisors so that any client assets, including crypto, would, in theory, have to be secured with qualified custodians. That usually includes banks or broker-dealers.
All right, let's dive into something that's creating waves across the financial landscape. Imagine this: you've invested in cryptocurrencies, watching the highs and lows, the crazy volatility that has both thrilled and terrified investors. You've read news headlines, seen Twitter debates, maybe even felt the excitement or panic of regulatory news. But now, there's a new kind of buzz. Crypto regulations are tightening, and major changes are on the way. In recent years, governments around the world have grown more serious about crypto regulation. It's no longer a vague threat in the background, it's now a priority for regulators, from the United States to the European Union to Asia. And these regulations are no small tweaks. We're talking about policies that could reshape the crypto landscape entirely. And here's the kicker: they could have a massive impact on your investments. You might be asking, what exactly are these new regulations and what do they mean for me? Good questions. These new laws and rules affect everything from tax obligations to how exchanges operate, even how specific cryptocurrencies might be classified. So whether you're a hardcore crypto enthusiast or someone who's just dipped a toe into the digital asset pool, this topic is one you can't afford to ignore. This video will break down the most important new regulations, showing exactly how they could affect your investments. We'll go beyond the basics, digging into what's happening on a global scale, and I'll share some insights on potential strategies for managing these shifts. So stick around, because by the end, you'll be ready to navigate this regulatory storm with clarity and confidence. Let's start with the why. Why are governments so focused on regulating crypto now? The answer isn't just about controlling money, it's about stability, transparency, and even security. Here's a breakdown of some key reasons. Number 1, consumer protection. In the wild world of crypto, we've seen massive scams and fraud cases. With billions lost to hackers and shady schemes, governments feel the need to protect consumers. Regulation can create safer trading environments by holding exchanges accountable and ensuring users are less vulnerable to fraud. Number 2, taxation and revenue. Many governments see the booming crypto market as a potential revenue stream. They want their cut, especially as crypto assets become a more common investment. Taxes are a big part of why these new regulations are coming into play. Without clear laws, tax evasion in crypto could go unchecked. Number 3, financial stability. Cryptocurrencies, with their volatile nature, can pose risks to financial stability. Big fluctuations or widespread adoption without oversight could destabilize economies. Governments want to create regulations that control this volatility, aiming to prevent financial crises that could have been avoided with proper safeguards. Number 4, national security. Crypto has also become a concern in terms of national security, as some cryptocurrencies have reportedly been used for illegal transactions or money laundering. Regulation aims to curb this by enforcing Know Your Customer (KYC) and anti-money laundering (AML) policies on exchanges. Number 5, encouraging innovation and competition. On the flip side, some governments also see potential in crypto to drive innovation. This is especially true in countries like Switzerland and Singapore, where regulators are working to create environments that foster blockchain advancements. So while some regulations may feel restrictive, others could actually create new opportunities for the industry to grow in a stable way. Now that we understand the why, let's look at what these regulations are and what they mean for you. Here are some of the most impactful regulations in the pipeline. Number 1, tax reporting requirements. One of the biggest regulatory moves affecting crypto investments is stricter tax reporting requirements. In countries like the US, the IRS has made it mandatory for crypto exchanges to report user transactions. This means you, as an investor, will likely have to report your gains and losses more thoroughly. Imagine that every single crypto transaction you make, whether it's trading Bitcoin for Ethereum or even purchasing an NFT, might need to be documented and taxed accordingly. For casual investors, this might seem overwhelming. For those who are more seasoned, it means staying on top of tax obligations to avoid penalties. Impact on investors. If you don't report, there's a risk of facing hefty fines. And if you're a frequent trader, you may need to rethink your strategies, perhaps by holding assets longer to avoid being overwhelmed with taxable events. Staying compliant will become key to avoiding tax-related headaches. Number 2, classification of cryptocurrencies as securities. Another significant regulation on the horizon is classifying certain cryptocurrencies as securities. This move is huge. If certain digital assets get labeled as securities, they will fall under stricter laws, similar to stocks and bonds, which would limit how they're traded, who can invest in them, and what companies are allowed to offer them. For example, the SEC has been in constant debate over whether certain tokens qualify as securities. This classification would mean that companies behind these tokens would be forced to disclose financial information, just like any public company, making the landscape far more transparent, but also more restrictive. For regular crypto investors, this could mean fewer available assets, as some tokens may not survive these requirements. It also means your choice of exchange might become limited if smaller exchanges can't handle the burden of compliance. The era of anyone can create a token may be ending, but that could make the ecosystem safer for everyone. Number 3, tighter exchange regulations. Crypto exchanges, think of Binance, Coinbase, Kraken, are where the majority of crypto trading happens. New regulations are expected to force these exchanges to adopt stricter KYC, know your customer, and AML anti-money laundering policies. Some exchanges are already adjusting to this by requiring more detailed user verification. But for many, these regulations will make it harder to operate without facing fines or being shut down. Additionally, some governments may even require that exchanges hold insurance against losses due to hacks, adding a layer of security for users. For crypto investors, tighter exchange regulations mean you may have to provide more personal information and go through longer onboarding processes. But the upside? Exchanges may become more secure, and with insurance, your funds could be safer than before. Number 4, stablecoin regulations. Stablecoins like USDT and USDC have become increasingly popular due to their pegged value. However, they're also under scrutiny, as governments fear they could disrupt fiat currencies. New regulations might require stablecoin issuers to hold a certain amount of reserves or even become regulated like traditional banks. For those who rely on stablecoins to store value or transfer funds, these regulations could either boost confidence or create some obstacles. If issuers are forced to be fully transparent, it could make stablecoins safer. However, stricter controls might mean fewer options and increased fees. Number 5, environmental regulations on mining. The environmental impact of cryptocurrency mining, particularly Bitcoin, is a growing concern. New regulations might enforce greener mining practices, requiring miners to use renewable energy or even pay extra fees for emissions. This might increase the cost of mining, potentially impacting Bitcoin's price and those who invest in mining-based assets. It could also lead to a shift in how coins are mined, with more focus on eco-friendly practices. So with all these changes in mind, what can you do to protect and grow your investments in this shifting regulatory landscape? Here are a few strategies. 1. Stay informed and compliant. Knowledge is your best defense. Follow regulatory news, understand tax obligations, and make sure you're compliant. Ignorance of the law won't protect you from penalties. 2. Diversify your portfolio. Diversifying across different types of crypto assets can help mitigate risk. If one category gets hit by new regulations, a well-balanced portfolio can keep your investments safer. 3. Consider holding stablecoins with strong backing. If you rely on stablecoins, consider those with transparent reserves. This can add a layer of security if regulations become more stringent. 4. Use reputable exchanges. As regulations increase, sticking to well-established exchanges can save you from potential issues. They're more likely to adapt to regulations quickly, offering a safer trading environment. 5. Reevaluate your risk tolerance. With new rules, the risk landscape changes. Assess how much risk you're willing to take and adjust your investments accordingly. So there you have it, new crypto regulations are coming, and they're likely to reshape how we invest in and interact with digital assets. From stricter tax requirements to classifications as securities, these changes are all about bringing order to a chaotic market. But as with any shift, there's opportunity for those who adapt. Understanding the landscape, staying compliant, and making informed choices can help you thrive in this new era of crypto regulation. Now, before you go, don't forget to like this video if you found it helpful, and subscribe to our channel for more insights on navigating the evolving world of cryptocurrency. Also, leave a comment below with your thoughts on these new regulations. How do you think they'll impact your investments? We'd love to hear your perspective. Thanks for watching, and stay tuned for our next deep dive into the world of digital assets.